At some point in your investing life, something quietly shifts. You've been doing everything right, automating contributions, ignoring the noise, letting the market do its thing, and then one day you look at your portfolio and realize it grew more in a single year than you actually put into it. Not because you got a windfall, not because you hit some lucky trade, just because the math finally caught up to the money. That moment has a name. It's called the crossover point. And it is, without question, the most important milestone in retirement investing that almost nobody talks about. This is Matt, and today we're going to break down exactly what the crossover point is, how to calculate yours, and why understanding it will completely change the way you think about every dollar you invest from this moment forward. Let's get into it. Here's the core concept. When you first start investing, you are the engine. Every month you deposit money, and the market does its best to grow it. But early on, the market's contribution to your portfolio is genuinely small. If you have $5,000 invested and the market returns 8%, you made $400 that year. If you're contributing $500 a month, that's $6,000 going in manually. Your deposits are driving growth by a factor of 15 to 1. You're doing all the heavy lifting. Now let the clock run forward. You've been consistent. You've got $200,000 in the account. At 8%, the market returns $16,000 that year without you lifting a finger. You're still contributing $6,000 annually. The market is now generating more than twice what you're putting in. The dynamic has shifted. Your contributions are no longer the primary engine. They're supplemental. Keep going to $400,000. The market hands you $32,000. You contribute $6,000. The market is generating more than 5 times your annual input. Your contributions at this point are mathematically a footnote. The crossover point is the specific moment when your portfolio's annual investment growth permanently surpasses your annual contributions. It's not a feeling, it's a calculable number, unique to every investor, and the moment you cross it, the game changes entirely. Before the crossover point, your behavior is the most important variable in your financial future. After it, time and compounding take that role. And here's what makes it genuinely powerful. Once you cross it, you never go back. The gap between your contributions and your portfolio's growth keeps widening every year. The math only gets better from there. Let's talk about how to find your crossover point. The formula is straightforward. Crossover point equals annual contributions divided by expected annual return rate. That's it. Your annual contributions are whatever you put into your investment accounts each year. 401k, Roth IRA, brokerage, all of it combined. Your expected return rate is the average annual return you reasonably expect from your portfolio over time. For a diversified index fund portfolio, 7 to 8% is the number most financial planners use for long-term projections. Not what the market did last year, the long-run average. Let's run through a few scenarios so this becomes concrete. An investor contributes $24,500 to their 401k and $7,500 to a Roth IRA each year, the 2026 maximums. Total annual contributions, $32,000. At 8%, $32,000 divided by 0.08 equals $400,000. Once that investor's portfolio hits $400,000, the market is generating as much as they're contributing, dollar for dollar. Past $400,000, the market takes the lead permanently. Scenario 2, Roth IRA only. An investor contributes $7,500 a year, the 2026 Roth IRA maximum. At 8%, $7,500 divided by 0.08 equals $93,750. The crossover point arrives much sooner. At $93,750, the market matches their annual contribution. That number is well within reach for a consistent investor inside of a decade. Scenario 3, mid-range contributor. An investor contributes $15,000 per year across a 401k and IRA combined. At 8%, $15,000 divided by 0.08 equals $187,500. That's the threshold. Cross $187,500 and the portfolio becomes the primary driver of growth. Notice what these illustrations illustrate. The higher your contributions, the higher your crossover point. That's not a reason to contribute less. It's a reason to understand that higher savers are playing a longer phase 1 before the snowball takes over. The payoff on the other side is proportionally larger. One important note. These calculations assume your investment return rate stays consistent with long-term historical averages. Markets fluctuate. Some years you'll see 15%, some years negative. The crossover point is a planning tool, not a guarantee. Use it to understand your trajectory, not to predict a specific date. Understanding the crossover point reveals something that most investing advice completely glosses over. Your investment journey has two fundamentally different phases, and they require different mindsets. Phase 1 is the contribution phase. This is the stretch from your first dollar invested up to the crossover point. In Phase 1, your savings rate is the single most important variable in your financial future. The market is helpful, but it's not doing enough volume yet to carry the weight on its own. What matters most is consistency. How much you contribute, how regularly, and how disciplined you are about not pulling money out. In Phase 1, every decision around your income and spending has a direct, outsized impact on your retirement outcome. A raise that goes into your investments instead of lifestyle inflation, that compresses your timeline to the crossover point meaningfully. An early 401k withdrawal that triggers taxes and penalties, that sets the clock back. Behavior is the lever. Phase 2 is the compounding phase. This begins at the crossover point and runs through retirement. In Phase 2, the portfolio is generating more growth each year than you're contributing, and that gap grows every single year because the base keeps expanding. At $400,000 with an 8% return, you earn $32,000 from growth. Next year, assuming no additional contributions, you're at roughly $432,000, earning $34,560. The year after that, $466,560, earning $37,325. Your contributions stayed flat. Your growth keeps climbing. This is the compounding curve people always talk about but rarely visualize clearly. In Phase 2, individual financial decisions still matter, but a single bad month of spending or a missed contribution won't derail your retirement. The portfolio has enough mass that it absorbs short-term turbulence. The anxiety that drives people to obsessively check their investment accounts every day is largely a Phase 1 phenomenon. In Phase 2, the math is structurally working in your favor. Steady management replaces daily vigilance. The reason this distinction matters is that most personal finance advice is written for Phase 1 investors and applied universally. Telling a Phase 2 investor to stress over every expense is like telling a freight train it needs to pedal harder. The engine is already running. The job now is to keep it on the tracks. There are 3 levers that directly determine how quickly you reach your crossover point. They're not secrets, but understanding them in the context of this specific milestone gives them new weight. Lever 1, contribution rate, the most direct input. The formula is annual contributions divided by return rate. You can't control return rate, not reliably long-term, but you can control what you contribute. Higher contributions raise your crossover point threshold, but also get you there faster because a larger annual deposit compounds more aggressively. The key is consistency. Sporadic investing is significantly less effective than automated recurring contributions because you're not trying to time anything. You're feeding the machine regardless of what the market is doing in any given month. Lever 2, return rate, or more accurately, not sabotaging it. You can't reliably outperform the market over decades. The evidence on this is overwhelming. What you can do is make sure your portfolio is positioned to capture the market's long-run returns efficiently. That means low-cost index funds. Expense ratios matter more than most people realize. A 1% annual fee on a $500,000 portfolio costs $5,000 a year, money that would otherwise be compounding. Over a 30-year horizon, fee drag can cost hundreds of thousands of dollars in final portfolio value. Minimizing fees is one of the highest ROI moves any investor can make, and it requires almost no ongoing effort. It also means staying invested during downturns. Investors who panic sold during the 2020 market crash and waited to re-enter locked in real losses and missed one of the fastest recoveries in market history. Volatility is the price of long-term returns. The crossover point math assumes you're collecting those returns, not selling out of them. Lever 3, portfolio continuity. This one is invisible until it isn't. Research from Fidelity shows that 41% of employees cash out their 401k when changing jobs rather than rolling it over. Every time that happens, an investor resets a portion of their compounding timeline, pays taxes, and often incurs a 10% early withdrawal penalty. From a crossover point perspective, it's the equivalent of draining the pool and starting over.
Rolling over old retirement accounts, keeping them invested, and treating long-term money as genuinely untouchable is one of the highest leverage habits in investing. The math doesn't care about job changes or economic cycles. It cares about how long the money stays in the market and compounds. Let's look at what the crossover point actually does to a portfolio over time, because the numbers are worth seeing clearly. Take an investor who contributes $30,000 per year and hits their crossover point at $375,000. At that moment, the market is generating $30,000 in growth, matching contributions exactly. 2 years later, assuming 8% growth and continued contributions, the portfolio is around $500,000. The market is now returning $40,000 per year. Contributions are still $30,000. The market is generating $10,000 more than the investor is contributing.
5 years past the crossover point, the portfolio is approaching $727,000. Market growth, $51,629 per year. Contributions, still $30,000. The gap is roughly $21,600. The investor's contributions, which represented 100% of portfolio growth in the early years, now represent around half of annual growth. The portfolio is doing the other half of the work. 10 years past the crossover point, the portfolio is over $1.24 million. Market growth, roughly $90,000 per year. Contributions, $30,000. The market is now generating about 3 times what the investor contributes annually. And this trajectory doesn't flatten. It continues to steepen, illustrating the power of compounding once the portfolio has reached critical mass. This is where the crossover point is worth understanding precisely. It's not just a concept, it's a threshold after which every single year of continued investing produces compounding returns that grow faster than the investor's own income-based contributions. The portfolio, over time, becomes an asset that works harder than the investor does. Now let's cover the 4 most common mistakes that delay or undermine the crossover point. Mistake 1. Stopping contributions at the crossover point. The crossover point doesn't mean stop. It means the portfolio is now pulling its weight alongside you. Continuing to contribute past this threshold accelerates the compounding curve dramatically. Coasting is an option. Quitting is a significant cost. Mistake 2. Using an inflated return rate in the calculation. Planning around 12% annual returns because that's what a bull market recently delivered is a setup for misaligned expectations. Use 7 to 8% for long-term planning. Be conservative. The math is better if you're pleasantly surprised than if you're blindsided. Mistake 3. Letting lifestyle inflation erode Phase 1 contributions. Lifestyle inflation is the most common silent killer of long-term wealth building. When income increases and spending rises to match it, contributions stagnate, which keeps the crossover point further away. The period between a meaningful income increase and a meaningful contribution increase should be measured in days, not years. Mistake 4. Ignoring inflation in long-term projections. The crossover point calculation uses nominal numbers. Over a 20 or 30-year timeline, inflation will erode purchasing power. Investors with long runways should factor in an inflation-adjusted return rate, commonly estimated around 5 to 6% in real terms when doing more precise planning. Here's the part about the crossover point that doesn't fit neatly into a spreadsheet but might matter most. Once you cross it, you can start living like your retirement has already begun, decades before you actually retire. Before the crossover point, there's this constant trade-off. Want to take a month-long trip to Europe? That's a mortgage payment you're not investing. Want to work part-time so you can spend mornings surfing or painting or coaching your kid's soccer team? That's income you're not funneling into your 401k. Every decision to live more fully today feels like it's stealing from your future. This is what financial independence actually looks like before you hit the traditional retirement age. It's not about quitting work entirely. It's about having enough momentum built up that you can finally start making decisions based on what makes life worth living, not just what maximizes your savings rate. The crossover point doesn't just fund your retirement, it buys back your time while you're still young enough to use it. Here's the thing most people miss about retirement investing. Everyone obsesses over beating the market, finding the right stock, timing the perfect entry point, and all of that is noise compared to the one thing that actually determines whether you retire comfortably or not, whether you hit your crossover point early enough for compounding to work at full strength. So here's what you do right now. Go calculate your crossover point. Write it down. Put it somewhere you'll see it. Make it your lock screen if you have to. And then ask yourself one question.
How many years away am I from crossing it, and what can I do this month to compress that timeline? Because every month you shave off the front end of phase 1 is a month you add to phase 2, where the math works exponentially harder in your favor. And that difference over the course of a lifetime is retirement at 55 versus retirement at 70. It's financial independence versus financial stress. It's the portfolio working for you instead of you working for the portfolio. This is the milestone that matters. Start chasing it today. If this video changed how you think about investing, hit the like button and let me know. Are you in phase 1 or phase 2? Have you hit the magic point? Encourage someone on the comments below. See you in the next one.